Welcome to the Three Edge Week in Review for the week of October 17th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will be discussing investment decision-making during periods of credit contraction. And so for our discussion today, you could think of a period of credit contraction as just describing times when liquidity is being extracted from the financial system by the tightening of monetary policy by central banks. And this is where we find ourselves today as the Fed raises short-term interest rates, shrinks its balance sheet in order to combat levels of inflation not seen in 40 years. The current environment remains challenging for risk assets. Markets continue to be influenced dramatically by monetary policy conditions. And this past week, equity markets have been subject to what I might refer to as a period of extreme sideways choppiness, up one day, down the next day. And as we saw from the report on the Consumer Price Index for September, the rate of inflation remains much too high for the Fed's liking, which means that markets are expecting the Fed to raise short-term interest rates by another 75 basis points at the FOMC meeting, which comes on the first 2 days of November. Continued monetary tightening to combat inflation has proved to be a headwind for the equity markets, but perhaps the bigger story at this point is the impact that Fed policy is having on bond yields. Investors are having to come to grips with the Fed's determination to raise short-term interest rates until they get inflation under control. And yields on U.S. Treasuries have now risen to levels last seen during the financial crisis. That was 15 years ago. For example, the yield on the 2-year Treasury now stands at around 4.6%, and it's quite astounding since the yield on the 2-year in October of 2021, which was 12 months ago, was less than 0.5%. The yield on the 10-year is currently around 4.2%, and 1 year ago, the Treasury yield for the 10-year was approximately 1.6%. The Fed's aggressive action has pushed the dollar to 20-year high against other of the world's major currencies, and the Japanese yen is now hovering around the 150 yen per dollar level, which is a 32-year low for the yen. And, although a strong dollar makes goods imported from outside the U.S. Cheaper, it also makes goods produced in the U.S. for exports to ex-U.S. markets more expensive. It worsens inflation outside the U.S., and it potentially hurts American companies' profits, since approximately 40% of the revenue from the companies that make up the S&P come from overseas. So that is problematic. So, Steve, let's get started. I feel like just about everything I described in my opening, if you will, is explained by monetary policy at this point. Everything is so related to that. And the Fed's tightening, which brings us to today's topic, which is investing during credit contraction. So perhaps just start by, if you could explain what is a credit contraction and what causes them to occur.
Well, Fritz, even before I specifically talk about credit contraction, let me just talk about credit. So credit is created when you have two parties, and we'll say one party is a bank and the other party is a corporation. The bank is the lender, corporation is the borrower. So when you have a lender and a borrower, you get credit. The lender, in this case the bank, is typically encouraged to lend money if they can lend money at a higher interest rate than what it costs them to get the money in the first place, and if they have confidence that the borrower is going to pay them back. And that confidence is increased when the economy looks favorable in the future. Similarly, the borrower is encouraged to borrow the money if they think they can put the money to good use and to invest it in a way that earns a higher profit and rate of return than the cost of their money. And their prospects brighten if they think the economy is going to look good too. So you've got a credit expansion that happens when you've got a motivated lender, a motivated borrower, they transact. That helps the economy does well. That creates a virtuous cycle where there's more lending, credit expansion eventually turns to credit boom. Economy does very, very well. And then eventually gets out of control. And that's when you might have overheated economy and inflationary problems like we've seen recently. So when the Fed realizes that things get out of hand through this virtuous cycle, then they put on the brakes. And that's what you referred to as a credit contraction. Now they're trying to reverse the process and squeeze liquidity out of the economy. Well, what's one way they do that? They make the cost of credit higher, more expensive, and they do that by raising interest rates. So now the banks realize that they have to pass on those higher costs to the borrowers. The borrowers think twice. Do they really want to keep borrowing money at the high rate? Are they going to be able to keep investing that profitably? Or do they need to worry now that we've got higher interest rates, that the economy is going to go south? And so you turn that virtuous cycle into a vicious cycle the other way. The credit contraction feeds on itself. Lenders are more reluctant to lend, borrowers are more reluctant to borrow, and the economy suffers in the process. So that's really a credit contraction. And it happens when things get too good in the credit expansion, and now the Fed realizes, often too late, that they need to hit the brakes. When they hit the brakes, we have that vicious cycle the other way.
Perfect. Excellent explanation. So then I guess my next question would be, why does that condition make the investing landscape so difficult for investors?
Well, it becomes much more difficult when we're in a credit expansion. Everyone thinks they're a genius. The bankers think they're brilliant by making so many profitable loans. The companies think they're brilliant by borrowing money at favorable rates and investing it in promising ventures and projects, et cetera. And everyone's making money and everyone thinks they're a genius. And it's only during the credit contraction when you find out which of the lenders were irresponsible in the way they lent and are going to suffer because they either lent to companies that aren't going to pay them back, or they got into trouble with certain projects. And then you've got the corporations or the borrowers, some of whom borrowed way above beyond their means because they could, and now they got to roll over that debt at much higher rates, and that's going to cause tremendous stress. And what often happens in the credit contraction is during that vicious cycle, you have companies that can't pay their debt, so they have to sell assets, and that asset sale causes the economy and the markets to get worse and worse. So what happens in the credit contraction is that the weakening economy can hurt many equities. The rising interest rates can hurt many bonds, and stocks and bonds both do badly, which makes it for a very difficult investment environment. And we looked at the typical portfolio type that Wall Street promotes, which is called the 60-40, meaning they promote that investors should put 60% or more of their money in equities and 40% or maybe a little less in bonds. Both equities and bonds have done so poorly during this credit contraction that it's been the worst year for 60-40 portfolio in any of the last 100 years. Yeah. So it's worse than the last century.
Yeah, unbelievable. So as this is my last question, it'd be similar to the third question that I ask every week, and that is, well, so first, in our recent third quarter webinar, and I've been out doing a lot of speaking as well this fall, and we spent a good amount of time talking about our three edge seasons of the market and that chart and how the economy and the capital markets go through cycles, as you mentioned, like the seasons in nature. And one of the seasons that we describe in the chart represents this idea of a credit contraction, which we say occurs in the fall, for the analogy. And so my final question is, okay, based on, well, we know what a credit contraction is, we know how they occur and why it makes things difficult. So how should investors think about this period in terms of their own portfolios?
Well, I love the fact you bring up the seasons of the market chart, and we've shown it before, and I'm highly confident we'll be showing it again because it really helps promote common sense investing. We do a lot of sophisticated mathematical modeling and analyses of the markets. We bring a lot of experience, but it all comes back to common sense. So if you look at the seasons of the market chart, just as a reminder, we have an analogy between the seasons and the market cycles. And we think of the recession as winter, when things are really tough. And at that point, central bank, the Federal Reserve Board, realizes that they want to help out. So they start trying to promote a credit expansion, But it takes time because lenders are wary of the recession, don't want to lend, borrowers or corporations don't want to borrow. So it really takes a lot of time. So they have to keep doing more and more. You finally get into the spring or the recovery mode, and the credit expansion starts to take hold. The economy is recovering. Everyone is feeling great. It's a great time to be in stocks. And then you move over to the summer where the market's overheated. This is when the credit contraction expansion gets out of control. You have that virtuous cycle. The economy starts to overheat. You get inflation. And the Fed often recognizes that too late, and inflation gets out of hand like it did recently. And then they put on the brakes, and now you move from summer to fall, credit contraction. And in the fall, equities do badly, bonds do badly, real assets start to not do as well. And the best investments are cash equivalents, and short maturity treasuries. Those are the winners, and so many other things don't do well. So when you think of the seasons of the market, it's just common sense that when you're in a credit expansion and recovery mode in the spring, you want to have more in equities. You want to focus more on return. When you're in the fall in a credit contraction, you better be focused more on risk management and preserving your capital. And we know from past credit contractions, cash is king, or cash equivalents, and equities do poorly in that environment. Now, I'll say something else. So many of the Wall Street firms promote what you might call a static asset allocation. What they'll tell you is just find your equity allocation and stick to it no matter what. And so often it's 60%, sometimes it's a bit more, but let's say 60%. And whatever's happening, just stick to the 60%. If the market goes down, go back to the 60% and hang in there. And what we say is that that's really not common sense. If we use the analogy of the seasons, think about someone who's trying to put on enough clothing to go outside. And it's summertime, and someone's telling them, like Wall Street, wear the same amount of clothing no matter what the season is.
Right.
So it's summer, and now they're really too hot, and Wall Street's saying, don't worry, it's hard to know what's going to happen, so just wear those clothes. And then they wear the same clothes this winter, and they're freezing. And we just think it's a lot more common sense to pay attention to the cycles. And right now, there's no question we are in a credit contraction.
Right,
we are in the fall, and just like this concept suggests, cash and cash equivalents are outperforming the stock and bond markets.
Dress accordingly, I guess, is the lesson. So great. Thank you. Thank you for shedding light on credit contractions and how they impact the global capital markets. So that will do it for Steve and me for this week. As a reminder, all of our videos are available on our 3Edge YouTube channel. In addition, all our videos and all of our written commentaries always available on our website. And you can find that at 3edgeam.com. And so until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.